Hi, I'm Dan Blondal, CEO of Nano One Materials. We are a process technology company specializing in lithium-ion battery cathode materials. Our first major market push is in lithium iron phosphate, and we have the most advanced and most economically viable alternative to Chinese LFP.
Dan, good to see you here.
Very good to see you here, too.
I'm surprised you're here. You've been on the road a while.
I have, yes.
How are you feeling?
I'm good right now. Yeah.
Getting a good reception out there?
Yeah, very good. The brand keeps getting bigger and bigger and bigger, and certainly here at PDAC, it's amazing just walking around how many people know us and come over to talk to us from whether that's in government or industry or investors or whatever. So yeah, very nice to see.
Yeah, and we'll talk about some of those industry players, government players in a second. We're just kind of catching up on some news. You're kind of just in a sell and leaseback
Yes.
deal. Why?
So essentially, we've moved from an owner to being a tenant. In very simple terms, we sold a piece of land sort of 3/4 of the way through last year that we weren't using, and then we sold the land underneath us in the shell of the building. All told, about $22 million. That all goes into the treasury. It's working capital that we can access today, and it's certainly very important. It's all completely non-dilutive, and we didn't lose the main assets, which are the people, the equipment, the plant, and of course the know-how. Those are actually all fundamental to our business plan.
Okay, so non-dilutive action, and kind of shoring up the balance sheet for now, especially in a market like this. So I mean, I don't know what you're hearing and seeing in the market at PDAC or even down at BMO where you were before, because you've been a lot of money's come from government grants, hasn't it? I mean, it's an interesting way of kind of funding.
Let me dial it back a couple of years, actually, because this whole process really began when we made the bid for the Johnson Matthey facility in Quebec. Yeah. We did our last public raise in 2021. We brought in $29 million, and some of that money was then directed towards this acquisition. We bought it for $10 million at the time. That attracted Rio Tinto in as well as an investor, so they came in for roughly 13 million Canadian at the time. And we also started working with the Quebec government. Eventually, we started working with the American government as well on really laying out the thesis for taking that facility in Quebec, converting it to the one pot process, bringing it back to its former sort of capacity or close to its former capacity, and funding all of that. So we started out with that $10 million investment. We brought in roughly $40 million from both the governments on either side of the border, and we just unlocked $22 million in stranded assets, because we have no business being a landowner at this point in our life cycle. So we turned 10 million into 60, I like to say, and it's all non-dilutive. And in today's market, so going back to what you were saying, the capital markets are very difficult right now. Anyone raising money is paying, and it's very, very expensive money. So all told, in the last 6 months, we've kind of finally crossed and circled $60 million in non-dilutive funds.
Right, and what's that? It's really interesting because it's a defensive strategy in the sense that going and constantly raising money, diluting people. But at the same time, what's that do for your share register? What's that do for your liquidity in moments like this?
Well, look, liquidity is low right now. There's the interest in the energy transition, interest in battery materials, in critical minerals is down, and we're at 40 low right now. So at a time when we don't have liquidity, it's very difficult for us to sort of leverage the capital markets. So it's a strategy. It's creative. We put all this stuff in place. We're not done. We've got a few more tricks up our sleeves that we're working on.
Okay.
But by and large, we've put all this stuff in place now. And what it does, what this 20 million, or sort of roughly what the sale and leaseback does, what that recent cash does, it allows us to start spending and then drawing down on the government funding, which is they reimburse for expenses.
Because that's all conditional.
It's all conditional on spending money. So they don't write you a check and put it in the bank. You have to actually execute on your plans.
They're matching your.
Well, and you have to execute on your plans. So you've got a program. You send, this is my project. This is what I'm going to do. These are the amount of jobs it's going to create. This is how much I'm going to invest in Quebec. This is how much I'm going to invest in the ecosystem. You say, okay, we like that. It's really good for us from energy security, from a supply chain security in the case of the U.S., and national security. They're all really, really fundamental drivers for the investments that are being made. So all told, it's a roughly $60+ million investment in the facility. Roughly, $10 million in capex into the facility. It's pretty simple. The reactors are all there. The spray dryers, all the equipment is there. It's really just a matter of replumbing, reautomating the equipment after we took hold of it, and just kind of and that gets us to a point where we can start making materials in larger volumes for potential customers. We haven't signed those sales deals yet, but they're all in works. We're in that qualification stage right now, but probably more importantly, that's the platform for our licensing strategy, the long-term license strategy. That's where you can do the demonstration. That's where you do the offtakes for larger plants. That's where the training will happen for potential licensees.
Right.
So getting that thing humming is certainly a very important part to executing our plans.
Okay, so you've outlined some of the commercial imperatives and some of the actions here that you're able to take, and you've chosen to take. Can we talk about some of the commercial opportunities? And there's a few variables in there which I would love you to kind of touch upon. One of them, I guess, the immediate one, most topical one, is obviously what's going on between the US and Canada. It's a very emotive subject this week, I'm finding out.
Yes. Well, I'm not going to weigh in on politics because it's
avoid politics.
That's for politicians, not for business people.
But let's look at what the impacts of that can be in terms of having to think standalone Canadian and non-US markets.
Yes.
And maybe some common sense prevails in the long term, and the US is in partner mode.
Yes.
Again, how are you viewing what's been going on at the moment? What's your lens?
Well, look, I'll give you from the Nano One side of things. That plant in Candiac had, let's say, we bring it back up to 1,000+ tons, maybe 1,600 tons. That's a small volume compared to anything that's been done in China. And so it's very easy for us to diversify that product globally. We have global interests, be they from Europe or even from Asia and other areas. So we can make some decisions that actually avoid some of the trade barriers that are kind of starting to pop up. And so that helps us diversify away from those. And then the other customers are largely defense and aerospace applications. They're small.
Yeah.
Some of them are European-based, some of them are North American-based. Right. But because we have the only LFP plant, they don't really have a choice.
Yeah.
So once again, we're kind of protected from any of these sort of trade barriers. It's just it'd be more expensive on the other side of the border, but they don't really have a choice because we're the only player that is completely decoupled from China, and that's fundamental to the national security and energy security mandate that these contractors have with various defense agencies. So that's another part of it, and then lastly the licensing strategy is immune to any of these, because it really we're licensed into the U.S. for instance. So if we enable a large U.S. player to tip up an LFP plant that can compete with China, that is decoupled from a supply chain point of view from China, then we actually answer. We basically address the very things that the U.S. is trying to do right now, is build industry there. We can do the same thing in Europe. We can do the same thing in the Asia Pacific region.
Right.
So the licensing strategy is very global and international and actually quite mobile.
Okay, so that definitely gets around things, and I'm sure there'll be exemptions coming down the line, or maybe complete removal of. But the US is the obvious partner, just in sheer terms of proximity, in terms of their critical mineral needs, etc. Okay, and with regards to sort of and I'm going to stick with the kind of commercial bit. With regards to other monies available to you, other options there. I mean, do you continue to talk to government bodies, government departments? Is that the kind of route that you continue to see as a way forward for raising capital, or do you have to start paying attention to the capital markets?
So we'll continue to tap whatever we can, and the government's there. And look, the new programs that are going to emerge, particularly if the geopolitical tensions keep moving like they do, right? There's going to be, we'll tap whatever we can, because that's good for the It's non-dilutive. It's good for the shareholders, and it's good for national interests and all kinds of reasons. But the reality is that any capital needs going forward ideally are going to be served either by the strategics or by the capital markets. Right. Capital markets are not a fun place to go to right now. So we'll keep our focus on strategics, and where the opportunities come to leverage capital markets, we'll do that. We're certainly poised for it. We have shelves in place and all of that, and but the windows are small and inopportune at this point. But there is tremendous strategic interest in what we're doing. So we brought Rio Tinto in, we brought Sumitomo Metal Mining in. Worley is in more of an in-kind type contribution because it's they're investing in the alliance. And putting the work in there, and then similarly, there's many other strategic interests that we're talking to. So there's a potential ways to shore up shore up things, but we really don't need a lot. We're largely got everything kind of worked out. There's some working capital in the coming years, but it's they're not big numbers.
Okay, well let's go back to the comment you made earlier, and just sticking with this kind of commercial realities and commercial opportunities. You said maybe the sheen has come off the EV and green thematic in the sense that it's getting a little bit wild and woolly.
Yeah.
Where we're at seems to be a sort of better, more conservative place. It's going to be all of the above, not just EV. I think a lot of manufacturers are talking about ICE, continuing to produce ICE, and that's fine. What does that do to the size of the market, the size of the opportunity, where you can go? I know you've talked about licensing there, but in terms of the addressable market for you, has that changed much?
I would say not really. I mean, we've seen a slowdown. If you still look at that, it's like a 29% increase year over year around the world. Now, most of that's China-based.
Yeah.
Europe and the US are kind of down in the single digits, but it's there and it's growing. On the like on ICE vehicles, they've all got larger battery packs in them for start-stop kind of applications or mild hybrid. That's all going to be there. It's an important part of the mix. We think LFP is going to play a big role there. It's also going to play a big role in any entry-level vehicles, and then ultimately the whole ESS market, so the energy storage market, be that for traditional kind of wind and solar sort of levelization, or be it for data center work. Those are the energy demands that are coming to us around the world right now, simply just from AI and data centers is massive. We won't see this kind of growth in demand side energy. We haven't seen this kind of growth in many decades. Right. So and that will all need batteries as well. So they've got to come from somewhere. They will be LFP by and large. In some cases there'll be different technologies, but LFP will play a very major role in that. So these are all fundamentals, and you know what? Look, the demand will go up and down year over year, but the drive is still big, and we see a really big opportunity.
Okay, and you're still positioning this to me as a kind of we are a market of one, ex-China.
Yes.
Ex-China. So in terms of the contracting, but which you referred to again earlier, that should make things a lot easier because there's a very kind of combative language around, Chinese trade and so forth. But needs must. Are you going to be able to time this well enough to get these contracts? Because the whole kind of first mover advantage is important, but when people get desperate, they're going to buy Chinese, right? So
that's part of it. Is they'll always go to the
lowest common denominator,
the safest. It's already in production. It's already in volume. Those are real risks. I think in the West is that there'll be this kind of, when push comes to shove, I'll just go buy the cheap stuff for stuff that's already proven.
So how do you compete?
So it's a really good question. So we have been thinking more about this organically through the plant we have. So the Kenya plant, like I say, it's not huge volumes. We could start to build confidence in our LFP product and our process by contracting to smaller players who will fill the volume in that plant. So, or fill the capacity of that plant, right? So once we fill that capacity, we start to have at least positive cash flow coming into the company and driving our expenses. And at the same time that's happening, you're starting to build confidence with other much larger players who can't offtake from that plant, but we can drive the offtakes from there. We can sample to them. We can do A, B, C sampling into the automotive industry. Spotty demand, but it's kind of you get paid for that stuff, and it goes to these plants. They test it, they beta test it, and eventually it ends up in a product on a production line going into a vehicle, and that drives the need for much larger plants, and it drives the whole licensing strategy.
Right.
So it's a platform technology, and of course the plant in Candiac is fundamental to it, but it has this added bonus of being able to generate revenue for us too. So it's not just we'll do training through there. We'll do off taking. What that does for, let's say, for a licensee, they don't have to go out and build a $100 million pilot plant or demo plant. They can use what we have, and we'll be continually updating that. It'll always have the latest and greatest technologies, and it will also, in the long run, we'll be able to use that to do one pot Gen 2. Right, and other chemistries. So that plant has this really long-term capability of being a really useful platform for us. And because it's already paid down and it already exists, and we actually have the most experienced team, that's why we believe we're further ahead than anyone right now.
Yeah, I guess time and to save them a lot of time.
Yeah, save them a lot of time.
That's correct. Okay, LFP.
So it helps address you asked about timing. Are you going to get the timing right on this? Look, that's anybody's guess how this all plays out, right? The timing wise. But I think we're kind of protected because we don't have these big capital lifts that we have to do. And so we can sustain a business and we can be ready and we're continuing trying to sort of build that business, but we don't have these big capital overhangs.
And I guess that's part of the sales message for you. It's kind of like LFP as a service in that sense that they can get to market quicker themselves. The licensees,
the licensees will come with big balance sheets, right?
Yeah.
And so we're not targeting other startups. We're targeting.
So the money's not the problem, though. Is the time. That's what this problem that you'll be solving for.
Yeah.
Right. Yeah, I get that.
Solve the time thing, and we de-risk. And one of the big de-risks, and this is not that well understood, is by getting rid of the wastewater. You de-risk this plant wherever it goes. So you de-risk the permitting. So it's a much easier to permit. Time. Right. A financial risk, because the problem with wastewater handling is it has to be designed for every single site you put it on. It's all custom. So you get ballooning engineering costs, and we all know what that means certainly in the mining space.
We'll face.
So we avoid that, right? So you shrink wrap this thing. There's no externalities. You can actually plop it down anywhere. You don't have to put it next to tidewater like they do in Asia, because you've got no discharge. So you can kind of plop it down anywhere, and actually you can make a distributed network of plants. You put them all together. You could put it next to a battery plant, but you don't need to because we don't have those. So you get more negotiating power on site location. So a whole bunch of benefits that come.
So let's look at decision making with some of these potential customers and these contracts, because that's the important bit. We talked about how we're raising money, how we're spending money, but we've got to make some money. What are the kind of the key drivers for them, not just in terms of the time you're going to save and money you're going to save them, but market conditions? Because this, like I say, this combative language from US and China at the moment is not helpful, but ultimately, as we've just said, your money talks. People will pay take the cheapest option, right? They look at their own balance sheet. How do you help sort of drive the made in the US potentially, or the North American friendly flow sheet, as it were, and how do you use that to your advantage? Because you want to get these guys over the line sooner rather than later. Technically, you're there, right? You've proved enough?
Yeah, we've proved it enough. We have to get through the the testing phase and the qualification phase,
right?
And China's it's a moving target, right? They get better and longer and deeper, every day. We don't have a plant here, right? So there is a moving target. We know we can always reach it. It's a matter of time and getting the right. And so you have to target the right customers, and these first customers are really key. They've got to be strategic. They've got to believe in the North American supply chain. And they've got to have the talent to make batteries, and there are precious few of those outside of Asia. So especially outside of and LFP, especially out of China. So it's not that hard to target who they are. They're largely in the aerospace and defense industry,
right?
And they're the ones who care about the North American supply chain because they're compelled to be there. and they're the ones that can ultimately bring about they can make cells. They know how to make them. And so they don't have those kind of risks that, let's say, an early stage battery manufacturer might have. So those are going to be fundamental to what we do. But then we build off those, and each one of them, as we build on them, brings more credibility and brings in another larger customer. Right?
But is there? I'm not saying like we need a loss leader here, but something along the lines of you say get that first one over the line, meaningful brand, credible brand. That will open up a lot of doors for you. And I've seen this at multiple times where anyone falling behind doesn't really have to do as much work. There's a lot of credibility done for them. What are the conversations you're having to allow maybe to put yourself in a position for something like that?
Well, so maybe to go back to your question about the made in the USA kind of thing, so we're talking fairly closely with all levels of government, and that's really important. Whether that be in the US or in Canada. And I think there's a tremendous amount of, actually, despite all of the tension you see out there, there's a tremendous amount of common thinking on that. And that common thinking is, look, we have to figure out how to decouple from China because they can cut supply chains off, willy-nilly. And Canada's very well positioned. I mean, we've got incredible natural resources here to service that. And I think saner heads will eventually prevail. We've got time to put all that stuff in place, and so I think that's a really big driver. So we're working, on the government relations, external affairs thing very, very actively. In fact, that's pretty much all I do here at PDAC. It's all very focused on that, not on capital markets.
Okay,
we've got people running around doing supply chain stuff and procurement stuff as well here, but my focus has largely been on building those networks and making sure that we know what's going on, what the thinking is, and trying to influence policy makers and things like that. So that has a big influence in it, and then picking the right partners, picking the partners that share the long-term vision, that are willing to come in and commit, invest a little bit now, or really they're in it for the long term, the long price. They're not thinking as transactionally, let's say, as some other players. So the transactional ones are going to be really important, but they probably come along later when you've demonstrated volume and you've demonstrated low price and
right. And how much of these conversations is around the technology component? Because it's all evolving.
Yes,
LFP is a relatively newish thing. There'll be other technologies come along. Are people just trying to work out the landscape and work out where LFP fits in? Because battery technology evolves, right? And use cases evolve. And when there's a kind of surge on the EV thing, then it kind of just drops off a bit, and people, they're working out their manufacturing realities, sales realities, all those other kind of financial pressures that they're under. Do you think sort of LFP has a place in a sustainable way going forward in battery technology?
Yes, it's a very short answer, and look, LFP has been around since the late 1990s, and it was actually first commercial. Actually, they first figured out how to make it work in Quebec. And that was at Hydro-Quebec and the University of Montreal, and they licensed one of the first licensees of that technology was Phosphate Lithium, which eventually became Nano One, and eventually built that plant that we now own and operate. And that know-how, that LFP, the first ton of LFP in the world was made in Quebec in 2005. So it's been around a long time. It eventually kind of made its way to China. It flourished there, largely because a lot of the IP protections weren't in place. No one envisaged China really kind of taking that on. And the technology that's used to make LFP was largely developed by my team in Montreal. And so we understand it. We know it well. We know where the flaws are. We know where the issues are, where the supply chain choke points are in China. And so we have to solve those. We can't copy it, bring it here, because the choke points won't work here. So we have to break those choke points, and that's the way you kind of pull it out of China. And that is being listened to at all levels here in North America, in Europe, both on the political front, but very much on the strategic, and OEM front as well. They totally get it. Timing is an issue, so you just have to find those first players who are going to go or are ready to go on the journey with you.
And they've got to be able to make money as well. So in terms of the efficiencies and the cost reduction, and ultimately being able to sell it, at a price which is attractive to both
Right.
sides of
Yeah,
the
and
equation,
look,
right?
we're not bringing a solution that is well, you can have this cleaner process, but it's going to cost you. Well, no, we
Yeah.
designed this. We collapse the PCAM, which is the precursor part of the step, and the CAM step into one. That allows us to kind of lithiate the product and form a lithiated sort of precursor that cooks really quickly in the furnace. And what that does is it drives down the capital cost, the operating cost, the energy intensity, ultimately the water intensity, and as I said, we have zero discharge. So so those are real big
competitive
benefits.
Yeah, absolutely.
And so it's what it does, if you can put that in place, that prevents Chinese technology from coming here, and that's fundamentally a point of national security for many for the U.S. and for Canada.
Okay, brilliant. Commercial understanding.
Yep.
Better understood. Thank you. Let's just finish off and get into sort of the admin and the tech of this, if you don't mind.
Yeah, no, please.
Just for people who are new to this story, right? So let's talk about that. So this one pot technology.
Yes.
Let's talk about what the competitors are doing. Then we'll kind of maybe have a look at the kind of green angle. I think you touched upon some of those sort of greener angles.
Yeah.
And then maybe talk a little bit about the actual product itself and use cases.
Okay.
Do you want to give us a sort of top line? Don't need a great deal of detail because your team has agreed with us to do a sort of 4-part series. Yes. We're going to get way into the details. So if this summary interests you, we can provide a much more detailed explanation separately, and we'll put a link somewhere.
Careful when I get into a deep dive.
Right. Okay. Yeah. So this was a summary, right?
Yeah, okay.
Do you want to sort of hit those main talking points?
Yeah, so we start with kind of one pot, what it is. So we've kind of just touched on it very briefly. So the one pot technology combines both the precursor and the cathode process. And what that is typically you prepare the iron and the phosphorus in one step, and then you lithiate it in a second step. And often it's two different companies. We combine that all into one, and we do it all. All the ingredients go into the one pot reactor, and we actually chemically process them in that reactor. Mm-hmm. There are some, one pot like processes out there where they just put them in, they mill it all. It's just a mixing method. We're not just mixing; we are actually chemically reacting the components in there to produce something different coming out. And that chemical sort of intermediate that comes out actually is very suitable working in high efficiency, let's say rotary kilns. So we can cook the material in a matter of 3 hours instead of 24. Right. So there's some great sort of energy intensity, efficiency, cost, and capital intensity, because the furnaces can be much smaller and much more compact. So those are where all of that leads to much greater savings. The way it's done in China today, they'll take iron sulfate. Piles of it's a tailings from titanium oxide refining. Mm-hmm. They'll take iron sulfate. They mix that. They have to sulfate it into iron. They have to dissolve it in sulfuric acid, react it with phosphoric acid. There's a series of processes, and you come out with iron phosphate, but all the water and sodium or calcium sulfate comes out, or even ammonium sulfate. There's a bunch of different ways of doing it, but you end up with this big waste stream, big wastewater stream. You got to treat it. That's very energy intensive. You got to discharge it. That's very capitally intensive. And then you got to deal with the waste stream, which is the solidified chemicals. Mm-hmm. And in many cases, there's no market for them, or there's not a big enough market for them. So what we do is we eliminate the sulfation plants, we eliminate the PCAM plant, and we eliminate the water treatment plants, and that's where a majority of the savings come from. If that's not too into the weeds, but that is fundamentally where it comes from. And then our furnaces are much more efficient, so the whole thing's more compact and cost competitive. And the beauty of it is that we can go from iron metal powder, iron oxide, or iron metallic powder, which leapfrogs the iron sulfate and allows us to access these materials here in North America and Europe, and where there are large refineries, there are very large iron companies that are making materials very close to that right now, and so we're working, for instance, with Rio Tinto. They're a partner in Nano One. We're working with a number of other iron suppliers to build those supply chains. Iron's at the crux of the whole thing. It's a great.
Thank you very much.
You're welcome.
I'll give you your $5 later.
Okay.
Yeah.
Yeah. So that if you can solve the iron supply issue, then I think we can wrestle the control of LFP out of Chinese hands.
Good stuff, Dan.
Yeah.
Seems to be heading the right way. 2025, hopes and dreams. What are we going for?
Look, 2025 is about executing on our scale up in Cognac, and really it's just capacity expansion of the existing facility. So we're going to continue to hammer away on that.
Yeah.
But really, what I think everyone wants to hear is, when are we going to get to revenue, right?
Yeah.
And so this is all focused on testing of our materials, validation with these customers, getting to a point where it'll start with an MOU or an LOI, and then ultimately some kind of a sales agreement. We'd love to be there by the end of the year. There's a lot of moving parts out there. As everyone knows, geopolitically, things are really shifting all around. But I think, with the partners we have the long view, and we think we can move that forward. So that's I think those are the big things in 2025. Hopefully some more government support where we can get it. We'll take everything we can get. But we're in a good place right now. We're well capitalized to execute on all the plans we've talked about, and we're looking forward to reporting out on it.